my best guess on this is that, $4,000 gold is a pretty hefty number for Canadians and almost 3,000 US. I mean, there are a lot of people out there with savings that are going to say, you know what, I need to buy gold. It's 3,000, it's 2,900 in a round number. That's a lot of loot for one small gold coin.
Absolutely.
And so I think, and this again, think that perhaps the retail market has been mitigated not by the need for gold or the understanding of gold, but the price of gold. I've always said for years, and I think we've talked about this in one of the earlier interviews, that, I've said two things. One, that gold will get so high a price that the average person can't afford it, so they'll move to silver because it's cheaper.
Unlike gold, which has long been a staple of central bank reserves, silver is now drawing attention as a critical asset for both monetary and industrial purposes. Silver is on the verge of a historic breakout, drawing increasing attention from investors worldwide. As of February 5, 2025, silver is trading at approximately $32.69 per ounce, with projections suggesting it could reach $50 per ounce by mid-year. Widely recognized analyst DavidMorgan believes gold's high price nearly is limiting retail demand, pushing buyers towards silver as a more affordable alternative. In this video, Morgan explains that gold shipments from the LBMA to New York were initially driven by concerns over potential tariffs. Uncertainty about whether commodities would be affected led holders to move their metal before the February 1, 2025 deadline. Following reports that surging gold shipments to the United States have led to a shortage in London and a massive new stockpile in New York, the London Bullion Market Association, LBMA, announced on Thursday that it was coordinating with CME Group and U.S. authorities to address the significant price premium of COMEX gold compared to the London market price. From a technical perspective, Morgan suggests that the current delays in gold delivery could indicate deeper structural issues within the gold market, particularly regarding the reliability of derivatives and the true availability of physical gold. While LBMA data shows 279 million ounces stored in London vaults as of December 2024, only 36 million ounces, the float, are theoretically available for immediate market use, revealing a critical liquidity shortfall against an estimated 380 million ounces of outstanding spot cash contracts. The delays effectively constitute technical defaults on these contracts, as sellers cannot meet delivery timelines. Drawing from historical context, Morgan cites Frank Veneroso's analysis of gold lending in the early 2000s. He explains how central banks loaned gold to bullion banks, which sold it for cash and invested in interest-bearing assets. While profitable, this system carried price risks, managed through futures or forward contracts. Now, we present the clips of DavidMorgan's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
As you well know, I have some pretty good sources. And this whole shipment out of the LBMA into New York primarily did revolve around tariffs initially. There's people out there that I respect, admire, that have basically stated otherwise, but that's how it started. So the reason being is that no one was sure of a couple things. One, if the tariffs are really going to be imposed. Secondly, whether they applied. Would they apply to commodities or not? People were thinking that they weren't going to apply to commodities. But rather than guess, the best thing to do would be to ship gold that could be encumbered by a tariff into New York before the deadline, which was the 1st of February 2025. So that was the beginning of it. But what happened along the way is it became apparent after a while that the gold deliveries were not being met in a timely manner. Now, if you buy metal at the spot market, it refers to on the spot. So I walk into the Ivan Precious Metals dealer there in Ontario, and I walk into your shop and I say, I want to buy gold. And you say, well, the spot price is, I don't know what it is, a Canadian dollar, 3,100. I don't know what it is.
It's 4,000 Canadian.
4,000, that's right. It is 4,000. This is the Canadian prepper. So 4,000 the ounce. And I put down 4,000 Canadian dollars, and you give it to me on the spot. That's really what it means. It means on immediate demand. Now, in the futures market, you can take a spot contract, and it takes a few days to clear before you get your metal. Well, the problem was that in the spot market, it wasn't being delivered on the spot. It was being delayed. And the more that was purchased, the longer the delays.
Right.
And so what I believe, and I've verified anecdotally, that people, or really entities like hedge funds, sovereign wealth funds, dealers, were getting concerned about their gold. And a lot of this gold is being what's called repatriated. So if I'm a nation state and I store at the LBMA and I'm finding out through other intermediaries that the gold deliveries are taking 4 to 8 weeks, now I have a reason to get my gold out of there and get it into my own hand.
Right.
And so it's gone from the worry about, will I have to pay a tariff to ship the gold to the United States, into I need to repatriate my gold. And so I want to back up and I won't say enlighten, but let me just go back to my history, because as you know, and many that follow my work know, I've been at this a long time. And if you go back into history, many, many years ago, in the early 2000s, I believe, there's a man named Frank Veneroso. And Frank Veneroso was a well-connected government / large wealth hedge fund manager. And he wrote a book called The Gold Book. I believe he wrote it every year. I have an electronic copy. I might even have a hard copy, I forget. But what he pointed out was that the gold lending program had accelerated to the point where we couldn't really trust these derivatives. So what happened was gold is sitting in vaults. It's not earning any interest. So the intermediaries, so the central banks, loan the gold to bullion banks. Well, bullion banks aren't going to hold that gold and pay storage fees on it. So what they did was they sent it to the market, bought it, sold it, and got cash for it. And the cash could be used to buy T-bills, for example. So if the gold loan was 1%, which what it was in those early days, so you're buying something for 1%, you're selling it into the market, and now you can take that cash and get 6%. You've got a 5% spread, and that works all day long.
Right.
And they're happy to do it. The only problem you have is a price risk. The price of gold could go up, the price of gold could go down. And you mitigate that price risk by going into the forwards market. So either the futures market, which is regulated, or the forwards market, which is actually bigger, which is the same as the futures market in most aspects, except it's private.
In his assessment, DavidMorgan asserts that central banks care deeply about gold, even if they downplay its importance publicly. He believes the situation has evolved from tariff concerns to outright gold repatriation, as entities grow fearful their gold may not be available. While silver is also affected, its role as an industrial metal and lack of central bank holdings make the impact less severe than gold's. The rare trade flows reveal how the commodities industry is being upended by Trump's trade policies, even before he makes good on repeated campaign pledges to impose hefty tariffs on trading foes and allies alike. He had signaled that levies could come as soon as February 1st, creating a further incentive to fly metal into the U.S. before the window of opportunity slams shut. According to data from Metals Focus, silver mine production increased by just 2% in 2024, failing to keep up with rising industrial and investment demand. However, he expects stress in the silver market, particularly as the next major delivery month approaches in March. Morgan warns that if shortages persist, authorities may intervene, as seen in past cases like the palladium market, where exchanges halted trading to control the situation. Let's get back to the interview.
The central banks care a lot about it.
Right.
In fact, they care about gold probably as much as anything. Of course, they're not going to say that in the public, because that would only fan the fire that's already started. So my bottom line is this. People are looking for their gold, and they're scared it may not be there. That's the bottom line. Now, I don't want to be an extremist. I don't want to be radical. I don't want to go over the top, but that's what it appears to be. So started off as tariffs, morphed into I need my gold, into basically a repatriation. Now, where does it apply in the silver market? I think it applies in the silver market, but not to the level that it does in the gold market as far as the need for gold, because silver is not a monetary asset. Central banks don't hold silver.
Absolutely.
So if central banks looked at silver the same way they look at gold as a tier one asset, the money of last resort, we'd probably see the silver market really flying, because the silver market's more leveraged than the gold market in my studied view. But since silver is primarily an industrial commodity, and most of the believers in silver from a monetary aspect are retail investors, not institutional investors. Yes, there's some institutional investors, but they were primarily through the ETFs, which are held by bullion banks anyway. So I think you can read between the lines there that there may be a more leeway perhaps in the silver market at this time than there would be in the gold market, because, as I just said, gold is money to central banks, whether they admit it or not. So that's the bottom line. There's basically been a run on the bank, or a run to gold, or a bank run on gold, or a gold run, whatever you want to call it. I think it could spill over. I'm pretty sure it will spill over to silver. And the next delivery month for silver is March. So we have kind of a breather here. You can, again, take delivery from an exchange, any of them on the spot market. But normally it's the delivery months where you're really geared up to take delivery, and that's March for silver. And so I'm just kind of waiting and watching.
Right.
Now, what I've stated, could I be inaccurate? In the general picture, no. In the short run, perhaps. In other words, there may be enough physical out there on both sides, physical silver, physical gold, to mitigate the problem and kind of, well, let's say, for want of a better expression, make it go away. But I doubt it. I think that once the genie's out of the bottle, it's hard to put him back in. And I think that's happened in the gold market. And again, it's going to appear. Now, what does this mean? And that remains to be determined. I mean, it could be where the authorities do what they've done in the past, where we had a run on palladium, for example. The exchange came in and basically they stopped the whole market. They stopped the derivatives market and they just put a big stop sign up. I'm not joking. And they said, we will determine, we, the exchange, will determine what leases are going to be made whole or made. We're going to determine how this problem is mitigated.
Gold prices hit an all-time high on Monday, driven by safe haven inflows following U.S. President Donald Trump's tariffs on Canada, China, and Mexico, which heightened inflation fears and concerns about economic growth. Silver also surged with projections suggesting it could climb to $50 per ounce by mid-year. With gold delivery delays and silver's increasing demand, could we soon witness a significant disruption in the precious metals market? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.